just very briefly, to tell you what I'm going to try and talk about for about 20 minutes, I'm going to give you a perspective on Deloitte's view of future trends in terms of what businesses like yourselves should do, some comments on Brexit, and then some areas to focus on from a tax perspective. But I guess before I get into that, Deloitte in Ireland, we have about 2,500 people now, and we grew to 250 million a turnover in the last year, a double-digit growth rate. In terms of back to future trends, I guess the key point I want to make people aware of that impacts on your tax and financial strategy is, as has been mentioned already, the consumer requirement has changed, is changing, and that has to influence your business strategy, your financial model, your tax model. And this is a bit of research we did in the US last year amongst 5,000 consumers. Broadly speaking, the message I'm trying to say is that the traditional value drivers of price, taste, and convenience are no longer as important. Broadly speaking, over 50% of the respondents to this survey of 5,000 consumers across all categories in the US are now saying that actually health and wellness, safety, social impact, and the experience of the consumer is much more important than ever before. And the reality is, if you as a business do not take that on board and feed it into your overall operating model, you will not succeed in the future. And I guess there's a nice alignment between this research and what Origin Green strategy is all about. And I guess, you know, it just underpins the need for change to move away from the basics, if you like, of price, taste, and convenience. I guess, how do you take advantage of those trends? Well, very simply put, you have to harness them in the context of what are you going to deliver to the consumer, and what is your operating model and manufacturing footprint to enable you to do that. Because at the end of the day, the focus of the consumer is moving from the left-hand side of price, taste, and convenience to the right-hand side of health, wellness, safety, social impact. It's a minority of people who are interested in that, but it's growing, and also the experience. And when we talk about experience, what we're being told by our US colleagues is that it's not just the experience you have in buying the product, it's the experience you have in tasting the product, and it's the experience you have afterwards in terms of the follow-up. And all of those feed into, well, what are you going to do as a business to evolve your model? And effectively, it comes back to innovation at the core, which has been referred to more than once already. It would be remiss of me to say, not to say anything about Brexit. I won't dwell on the negative. The negative has been killed to death over the last while. A couple of positives as we see from a Deloitte perspective. One, the UK is actually an attractive place to make an acquisition right now, if you get the right model and if you get the right business. And it could be a merger rather than an acquisition in terms of a balance portfolio. And looking at it through more selfish Irish eyes, if you're a business exporting into the UK, there are opportunities in terms of some of those UK businesses that are exporting out at the moment. If you look at the markets they're exporting to, they could be more attractive for you as an Irish business going forward than heretofore because of the costs and so on involved. And they're just two key areas, but counterintuitively, we would believe there are acquisition opportunities and merger opportunities coming out of the change that's ahead of us over the next number of years. And it's about being selective and careful about your partners. And at one level, it's much more difficult to trust somebody to manufacture your product in the UK for the UK market, if that's what you end up doing, as opposed to setting up your own manufacturing plant. And they are the decision points that people will have to grapple with over the next while. And at the end of that continuum is that merger scenario in terms of if people are like-minded. And that's just something to reflect on. I guess from a tax point of view, the two key areas of focus that we would see in terms of those consumer trends and also the tax trends are really around foreign expansion, which is obvious. The Irish consumer market is too small for an ambitious business to grow to the level that they would like to grow. And the other area is innovation. And both of those aspects have to feed into your tax strategy and your financial strategy. And we're just going to spend a few minutes talking about those and give you our perspective as to how, because the tax rules are obviously changing, and you have to bear that in mind. And I guess before I come on to that, in terms of that expansion piece, one of the points that was raised by some of the earlier speakers around Brexit and the impact and the currency and so on. Post Apple and everything else, what's very clear to everyone is that the one thing we can control is our tax rate, 12.5%. The issue has been, what is the level of profit taxable at 12.5%? And one way of bridging the gap for Indigenous Ireland in terms of Brexit, which would be a real statement, is reducing our headline tax rate, because that is what is within our control. And at the end of the day, a lot of multinationals don't even pay up to 5%. So the cost to the exchequer of reducing the headline rate to 12.5 to 5 would go a long ways to soften the difficulties of Indigenous Ireland vis-a-vis Brexit over the next number of years. Obviously, that's a difficult call to make, but that's a key lever that could be used in engagement with government and in seeking a change there around that, because a change there could have a direct impact on your free cash flow. Just in terms of foreign expansion, the typical model at the moment is people sell into another market. They may or may not have a sales force in that market. If they do, the rules of the game are to ensure that you don't conclude contracts in that other market, and you simply then just pay tax in Ireland, if that's your base, and you don't pay tax in the UK or anywhere else. And that's the model. The rules are now changing such that if you do have people boots on the ground in the foreign market, and they are selling, persuading customers to sign contracts, even if those contracts are signed in Ireland, you're now running the risk of having to pay tax in the like of France, Germany, UK, and so on. And that's going to evolve over the next number of years. In the same vein, if you have warehouses in some of those foreign countries that up to now you might have a tax liability, going forward, you may well have an issue to deal with. And I guess that's just an early warning of something that you need to bear in mind in the context of your sales model and your supply chain model as to what impact that will have around your tax leakage. And, you know, tax ultimately feeds into your free cash flow, but if you take action now, particularly around IT systems, then you can be very well prepared for the challenges ahead. And once you're prepared, you can ensure that in some instances you don't suffer any leakage in that foreign market, notwithstanding the changes. In other words, you pay 12.5% and nothing in the foreign market, or you might have to, with care, leak some, but protect 90% of your profit. In terms of, I suppose, a further iteration of that, what is going to evolve in our view over the next while is more collaboration with UK firms, more changes in manufacturing footprint to mitigate against the risks of what's going to arise, having the manufacturing plant in market, or indeed collaborating with somebody where you're going to use their plant if you're not at that scale. All that is going to give rise to complicated tax issues. And at the end of the day, the key message I'm trying to put across on this slide is that we have a 12.5% tax rate. The tax rates that apply in all other European countries are broadly higher than ours. France, it's 30% plus. Germany's of that order. So really, one has to be really careful going forward in terms of managing your supply chain footprint and your sales model to ensure you don't leak tax in those countries. And I guess the core message I want to put across is that, you know, with care and organizing yourself correctly, you can ensure that broadly up to 90% of your profit will still be liable to tax at 12.5%, with the balance then taxable at the higher rates in those foreign jurisdictions. But you have to be really careful in terms of how you organize your manufacturing and your sales model, and particularly where your brand team are located. That's really important. And, you know, I suppose early planning is key in that, and late planning means you're going to leak tax. Coming to innovation, obviously I'm sure everybody in the room knows about grants and so on. There would still be a view they're underutilized. On the R&D tax credit, the R&D tax credit is claimed predominantly by the multinationals in this country. There is a significant underclaiming of R&D tax credit by Indigenous Ireland, particularly in food and beverage. There's lots of things you can do in a food and beverage context that actually qualify for the R&D tax credit that are not being claimed today. And that effectively is free money. It's effectively 25% refund of your R&D cost that you're foregoing today. And that's a significant opportunity you're foregoing. Two very simple areas that qualify for R&D tax credit is if you evolve your packaging, that can qualify for R&D tax credit in terms of the cost of that. And even if you evolve your manufacturing process, that can also qualify for your R&D tax credit. And both of those are very simple examples, but there's lots more. And I guess at a high level, we would say that the extent to which R&D tax credits can be claimed by the food and beverage sector in Ireland is we're only scratching the surface. And there's a large opportunity there if people look very carefully. And the misnomer is that just because in your business you're spending money and you don't think of it as R&D, it actually could be R&D for tax purposes because of the way the definitions work and how it flows. Another new relief that was introduced last year, potentially of less benefit, is that in certain instances, if you're doing something novel, it may or may not be patented, then in that instance, instead of paying tax at 12.5% on your profits, you can pay tax at 6.25% of your profits. Now, if you, in the context of Brexit and everything else, if you can shift a proportion of your profits into that category, in effect, you're now paying tax at 6.25% as opposed to 12.5%. And that's a big win. Now, that will only apply to certain companies, and it really is down to what is novel. But there's a significant opportunity there for businesses, both large and small. It's more narrower for large businesses. Broadly, it has to be patented. For smaller businesses, it can be novel, but it doesn't have to be patented. And just to bear that in mind. And I guess just to conclude on the R&D and the KDB Knowledge Development Box, there is significant opportunity in this space. In our experience, people aren't giving it enough focus, and there's money that's available there that can enhance your cash flow that is going untapped. I guess one area that can be a real cost to your business that only comes up after the event when people don't realize what has occurred is that in the world we now live in, employees are mobile, particularly into other markets, obviously. That mobility can give rise to personal tax exposures for the individual, but more importantly, and as important, it can give rise to payroll tax exposures for the companies in those markets. And in my experience over the years, the one area where companies have had to pay big money out on tax audit settlements in the UK and elsewhere is not on transfer pricing or corporate tax, it's in payroll taxes, because people don't appreciate the rules and what the triggers are. And okay, people understand that if you're over 183 days in some countries, you have a problem. But what people don't understand is the triggers in some countries can be as low as 60 days. And unless you're compliant, the cost of non-compliance can be very severe, because the UK and other tax authorities are not shy about imposing interest and penalties. And a central message in terms of compliance is, do you know where your people are traveling and how many days they're spending in the relevant countries as to whether you're passing those trigger points or not? So my takeaways are gone off the slide, but just to summarize, be compliant. Make sure that your operating model is maximized to the maximum extent in terms of maximizing your free cash flow. Avail of every incentive that's available. It's legitimate to avail of them. They're there to be availed of. At the moment, they're not being availed of to the maximum possible extent. Notwithstanding Brexit, we believe there are opportunities, and it's to think more broadly in terms of what kind of collaborations you could have with your UK peers to drive the opportunity. And at the end of the day, think of yourself. One slide I didn't cover in terms of the time was reward. And, the reward space ultimately is at the individual level. And you have to think about, well, with our high tax rate at a personal level, what can you deliver to individuals at a capital gains rate? But more importantly, because of the mobile world we're living in, a takeaway I want to leave you with is, if you have a senior guy or lady who's going to need to travel, because of the way they're traveling and the days they're spending in different countries, that can give rise to opportunity in terms of income or capital gain may not be taxed at all. And that's a way of really rewarding some of your senior people or key people, or indeed yourselves, in terms of that dynamic. Because at the end of the day, your business has to be successful, but you personally also have to be successful, both financially and more holistically. With that, I'm going to conclude, and thank you for your time.